Bank failures in recent years have some business owners a little nervous about the potential of future bank failures. So how can you put your mind at ease? How can you protect your business from future bank failures? Hello again everyone, I'm Matt Sexton, banking writer at Fit Small Business. Today we're going to talk about the 5 things you need to know to protect your business from bank failures. For more information, check out our full article on our website by clicking the link in the description box below. Here are the 5 things you need to know to protect your business from bank failures. Number 1, understand FDIC limits for different accounts and what accounts are covered. Different types of bank accounts are covered differently by the Federal Deposit Insurance Corporation, or FDIC for short. You can see a chart on screen that shows the standard insurance amounts for specific account types. Generally, you are insured up to $250,000. However, there are ways to increase your insurance amount, which is what we will discuss in this video. The FDIC covers certain types of accounts, while other accounts are not backed by the FDIC. On screen, you see a list of the types of accounts that are covered by the FDIC insurance, including business checking accounts, business now accounts, business savings and money market accounts, business time deposits, and other official items issued by the bank. There are types of accounts that are not covered by FDIC insurance, including stock and bond investments, mutual funds, life insurance policies, annuities, municipal securities, safe deposit boxes, or U.S. Treasury bills, bonds, or notes. Number 2, open business bank accounts at multiple banks. Because there is a limit to the amount of your finances in a specific bank that are FDIC insured, usually $250,000, you may need to open accounts at multiple banks to increase the amount of your business finances that are backed by FDIC insurance. On screen are 2 examples of how $375,000 would be insured if you had accounts at multiple banks compared to just one bank. In example 2, the entire $375,000 would be insured in the event of a bank failure. In example 1, you would have $125,000 that would not be insured. Number 3, open accounts at credit unions or seek additional types of insurance. While we have mentioned FDIC insurance, there are other types of insurance. Credit unions are insured by the National Credit Union Administration up to $250,000 per account, so you can open a business account at your local credit union to get additional coverage. You can also find a bank that is a member of the Depositors Insurance Fund, which can allow you to extend your coverage. Many banks are members of both the FDIC and the DIF. Finally, there are external companies that provide additional insurance above FDIC limits. Wintrust is an example of a company that offers a program that extends insurance up to $3.75 million. Number 4, find a bank or fintech that uses a sweep network to extend your coverage. Banks and financial technology companies have the ability to insure business funds beyond the $250,000 limit using IntraFi network deposits. That company combined CDARS and ICS into IntraFi. IntraFi is a network of more than 3,000 banks nationwide, providing CDARS and ICS to allow banks to spread deposits across multiple financial institutions, with customers receiving $250,000 of FDIC insurance into each bank. The one drawback to CDARS is it has limited liquidity because it is a CD. In the event of a financial emergency, you will likely have to pay a penalty for early withdrawal. Banks also have to pay a fee to access a CD in CDARS, making the return on investment for the bank less than other options. Number 5, you should keep enough funds liquid to manage short-term emergencies. While insurance is important to protect your business from bank failure, there are other things you should do to protect your business in the short-term aftermath of a bank failure. While it is important for businesses to invest funds to continue long-term growth, it is also crucial to have short-term liquidity to deal with a potential bank failure. When planning your investments, stagger your timed investments, such as a CD that is part of a CD ladder, so that you have funds available regularly. In addition, funds in overseas banks may not be easily liquidated in the event of an emergency. Also, those funds may not be insured in the event of a foreign bank failure. It is best to keep as much of your business finances in domestic banks as possible. Ensure your financial planning includes having enough liquidity to cover at least 30 days worth of expenses. This should protect you until the FDIC starts issuing checks to cover failed bank assets. That wraps up our list of the 5 things you need to know in the event of a bank failure. For more things you should consider, including what to do in the immediate aftermath of a bank failure, see our article on the topic on our website, which is linked in the description box below. In addition, check out our guide to the best small business checking accounts to find banking providers with extended FDIC insurance coverage. I'm Matt Sexton for Fit Small Business. Thank you again for joining us, and we'll see you next time.